Hello, everyone. A very good morning. I welcome you all to today's webinar hosted by Cashflow. Let's kickstart today's webinar. I would like to introduce today's speaker, Mr. Sunil Gabawala. He's a highly accomplished chartered and cost accountant with over 25 years of experience. He has led firms focusing on tax, including VAT, service tax, and GST. Mr. Sunil Gabawala has also authorized several books, including a renowned treatise on service tax and actively contributes to the GST policy. A sought after speaker, he has delivered lectures at various industry forums, trained government officers, and written extensively on indirect tax. He's a former president of the Bombay Chartered Accountants Society and currently chairs its Indirect Tax Committee. I would now like Mr. Sunil to begin with today's webinar. Thank you so much, Sunilji, for joining us today.
Thank you, Surbhi. It's always a pleasure to speak on the recent changes. And luckily, this year we have quite a lot of changes which have come in. And most of the changes, as the audience is now aware about, because it has been a few days since the announcement, are more in the line of a positive change in terms of some removal of the inverted duty rate challenges, as well as a reduction in the rate matrix. Lot of, has been talked about the so-called celebrated GST 2.0. And I think in that sense, having a session like this, which goes into a deep dive of the changes and the propositions, may make sense for the users to really understand the macro picture and also understand the specific issues and the way forward in this regard. Without much ado, we can straight away move into this entire discussion about the 56th Council meeting recommendations. We are all aware of the backdrop of within which this meeting was conducted. On the Independence Day, the Prime Minister had announced that he was planning to give a sort of a Diwali gift by way of a GST rationalization. And that objective of GST rationalization was expected to be on three broad pillars. And the idea was that we will try to simplify the processes for businesses as well as reduce the tax burden on the end consumer. So a balance was committed between both benefiting industry to some extent, industry and businesses to some extent, at the same time ensuring a benefit to the end consumer by way of a reduction in the tax rates, resulting in a consequential reduction in the prices. And in that background, the GST Council met. The meeting was scheduled for 2 consecutive days, but sensing the urgency, considering the macroeconomic parameters and other things, the council set overtime. And at the end of the first day itself, around 9:30 or so, the council concluded the meeting on the first day itself. And this was actually a pleasant surprise, because it's very rare that that sense of urgency is shown by the government, and here we could really see that urgency coming in. And interestingly, all the decisions were taken by consensus across all the states. As we are aware, the council meeting, council consists of not only the union finance minister, but the finance ministers of all the states, including opposition ruled states. So politics is a secondary side of it, and maybe in the entire process, economy and GST came out as a winner and politics took a backseat. Then that was good, according to me, for the country as a whole. And we could, on the day one itself, come to a consensus on the proposed changes which are being brought about. Of course, these are all changes, and the finance minister in her press meeting did announce that these changes would become effective a little bit earlier than what even the prime minister committed. So instead of Diwali, we are seeing these changes getting implemented from the 22nd of September, which coincides to be the first day of the festive season of Navratri. And that was very clearly communicated by the finance minister. We should be expecting the notifications in a few days, and those notifications definitely would, I'm not very unsure about it. I believe that those notifications would be in line with whatever has been tabulated in the press release and the FAQs which have been issued at the time of the GST Council meeting. So without much ado, let us quickly look at what are we going to cover today. And I think the path to talk about today is primarily concerning the tax rate changes, because there are many tax rate changes, and honestly we may not be able to deal into each micro product. But what we'll try to do is we'll have two baskets of discussion as far as the tax rates are concerned. We'll first understand the macro feel of the changes in the tax rate and how are the broad changes happening, and in case your product tax rate changes or your service tax rate changes, what are the things which you need to be careful about. So a macro level, without going into the specific sector or a product or a service, we'll first try to analyze a generic understanding about the impact of the tax rate changes. Thereafter, we'll shift focus onto certain substantive announcements. There are two substantive announcements which are going to impact the industry and businesses at large. So we'll talk about it. There was a discussion about ease of doing business, and there are some procedural changes in that regard. So we'll try to analyze that. And thereafter, we'll circle back to the tax rate changes and then pick up sector by sector and understand the changes in the tax rates of goods or services in relation to that sector and try to see how it's going to impact that sector in general. And finally, we'll end up with a small note on the way forward in this regard. So that is, I think, the broad structure of today's presentation. And without spending too much time, let's straight away go to the rate structure. We are aware of the current rate structure. There are five broad rates. There are certain exceptions like you have gold, diamond, etc. But this those would always be considered as exceptions. When you look at the slabs or the schedules, there are broadly five broad schedules of tax rates. Today, we have a general revenue neutral rate of 18%. We have a demerit rate of 28%, coupled with a compensation cess on specific types of products. We have two merit rates, 5 and 12, and we have a exemption for priority products and services. So we are aware of this five slab structure, and the objective was really to simplify this structure. And how are we trying to do that? We have tried to do two important things here, and that is what is important to understand. Firstly, we are removing the 12% structure by itself. So there will be no longer be a 12% tax rate. The emphasis is that whatever products or services were currently attracting 12% have been moved to either 5 or 18. Of course, in exceptional cases, they move somewhere else. But more or less, most of the products we have tried to move into 5. Some of them have gone into 18. But we said that this 12% structure having multiplicity of tax rates results in unnecessary classification disputes, because somebody would charge 12% only after 5 years to discover that an officer comes back and says that no, it should not be 12, it should be 18. So to avoid those types of litigation and classification disputes, the attempt is to reduce this multiplicity of rates. And the first attempt is to remove really the 12% rate. So a quick take home for us is that if any of our products or services have been currently in the 12% bracket, we need to question, we need to check. Definitely there is likely to be some impact, and it will move into either 5 or 18. Similarly, compensation cess was expected to be for 5 years. It got extended by a couple of years, but it cannot continue for a long term. Therefore, we are now saying that the cess will go away. Cess is being discontinued. And because these are products which are sin goods, the 28% tax plus the cess is being merged into a demerit rate of 40%. So you might have luxury cars here, you might have various types of tobacco products or soft drinks fitting into this category. Of course, as far as tobacco products is concerned, there is a small caveat, and that's where you have a conditions apply while a star against that says discontinue. The finance minister has said that basically the cess was meant to compensate the states for revenue loss, and in the interim, the center had to take a loan, intergovernmental loan, to pay the cess compensation to the different states. Now there is some deficit of a loan on that front. So the idea is that the tobacco products will continue to bear the cess till the time this loan is repaid. And there's no outer timeline which has been defined right now, but yes, till the time the center clears off its loan and closes its obligations of payment of cess compensation to the states, till that time only on the tobacco products, which is a very specific sector, the cess will continue. Otherwise, subject to that, all other products, including substantially the auto sector, where the cess was a major hurdle and a cost, that is being discontinued, and all of that is being merged into either the 18 or the 40% bracket. So moving forward, we have essentially only a revenue neutral rate of 18%, a merit rate of 5%, and a demerit rate for same goods or luxury goods of 40%. Of course, the exemption list will have to continue. So therefore, wherever the products or services were in the 12 or the 28% basket, necessarily there is a change. And in other cases also, there have been certain realignments to ensure a proper consolidation or to avoid controversies or classification disputes. For example, we are told all auto parts will now be under a singular bracket of 18%. So, in that sense, a lot of rationalization is being brought about. A lot of dependence on HSN and the classification is sought to be done away with by trying to classify similarly defined products into a single tax rate rather than have separate tax rates. And we have all seen the the debates which went around, the tax rates on popcorn, if it is salted, if it is caramelized, and if it is sold or it is supplied in a restaurant. Different types of tax implications were arising, and that was creating a lot of uncertainty and also giving a bad publicity to this entire process of GST implementation. And that is the objective, I think, of this entire structure of GST 2.0. The thought process is to consolidate, try to have as minimal tax rates as possible, because minimal slabs will mean minimal disputes as far as classification is concerned. So, in that sense, I think it's a very good move to really try to circumvent or avoid classification disputes to the extent possible. I reserve my comments on the overall macro impact on this at a later point of time towards the end when we look at the way forward. We'll try to reflect whether this is really a GST 2.0 or there could have been something more, but let's park it for the time being. Let's first understand and assimilate the proposals which have been provided for. Now, stepping back from this tax rate, let's look at a situation where assuming that your product tax or the service tax rate is changing. So, what are the important things which we need to know? The first thing is that, of course, the provisions are effective from the 22nd of September 2025. I already highlighted that it's the first day of the Navratri, and on that auspicious day, we want to trigger the changes. Of course, one can question and debate the mid period, mid month, not even a mid year, but a mid month implementation. But well, that's what it is all about. The finance minister has also tweeted from her handle, specifically highlighting and asking companies to prepare their invoicing systems and their softwares accordingly, so that from 22nd September, the new rates can be implemented in the invoicing and the transactional details. Of course, as I said, the notifications are not out, but I think that's merely a formality. They would definitely be out in some time, and therefore one may like to look at the proposals right now as more or less sort of finalized types of proposals. An important discussion which happened immediately in the press release, press meeting after the GST Council meeting, was a question by the press, and which is a very valid question, that today the whole objective of reducing rates, you have reduced rates lock, stock, and barrel on most of the consumer products. Something like a talcum powder is now reduced to 5%, soaps, shampoos, etc. When there is such a substantive reduction in the tax rate, the objective clearly is to benefit the end consumer and improve the consumption of the product, or maybe bring a buoyancy in the economy. But the press was quick to highlight that there are no anti-profiteering provisions. Most of us are aware that in the earlier budget, the anti-profiteering provision section 171 has been given a go by. No fresh complaints can be filed. Only old complaints will continue to be litigated and adjudicated by the tribunal. But since there is no anti-profiteering provision moving forward, the question which comes up is, what is the comfort that the industry will pass on the tax benefits? So the answer to that is simple. On a legal front, there is nothing in the law which forces an industry to pass on the tax benefits to the end consumer. But it would be a good practice, and all of us are aware that in the changing times, companies want to look at it as a sort of a business rationale, and if they are benefiting, they would want to pass on that benefit so that at least there is a demand increase. And at some point of time, maybe there can be temporary aberrations, but at some point of time, the market forces will take over. And because of the perfect competition, and we are aware about this situation of competitive economics, that demand and supply will ultimately, the markets will take over, and accordingly, the prices will have to discount this factor. So in that sense, I think wisely enough, the revenue secretary also responded accordingly that the industry is mature enough to pass on the benefits. Of course, of late we are seeing some communications or Twitter discussions and interviews snippets where the finance ministry is trying to suggest that we will take certain action and we will watch closely that the industry passes on the benefit. One will have to really wait and watch, but honestly, we are also seeing some auto majors have also announced that they are in fact going ahead and passing on the benefits of the tax rate changes. So, not going too much into the legal side of it, I would believe practically and the market dynamics will somewhere bring in that benefit to the end consumer. Maybe not immediately in some cases, but at maybe a few months down the line, it will definitely have to pass. But when you are dealing, especially in B2B transactions, in situations where you are dealing with government bodies or PSUs, or you have long-term rate contracts, mind you, most of the contracts might have specific contractual clauses dealing with anti-profiteering. Most of the government contracts have what is known as a subsequent legislation clause or a change in rate clause. If your contracts with the customers have those types of clauses, those clauses in effect would mean that the benefits which you are deriving because of these changes in the tax structure should be passed on. So you will have to look at those clauses and accordingly contractually and commercially calculate the benefits and pass it on by way of a discount or a reduction in the pricing. So in that sense, I think all in all, no legal provision, but either market dynamics or contractual clauses will make sure that the benefit end of the day passes on to the end consumer. Let's move slightly ahead, and as a business, let's understand what how do I ensure a transition. One, of course, is the pricing and the relabeling, especially in the MRP driven products. There is a requirement of relabeling because the pricing might change. So that is a transition. That's those are administrative facets which one needs to look at. But from a tax and a GST perspective, what is the impact of the transition? And also the impact on the reversal, especially if you are moving from a taxable rate to a nil rate. Many some of the products are moving from 5 to 0 or are moving from a situation of 12% with input credit to a situation of 5% without input credit. In those cases, there will be a concept of input credit reversal. So those two aspects we can now discuss and take them up one by one before we really go into the substantive amendments. So as we are aware that whenever there is a change in the tax rate, and I think we already got a couple of questions in this regard, that because we are aware that individual medical policy is now given an exemption. Earlier there was an 18% tax rate, and therefore one of my neighbors came back and asked me that look, I took a policy in July and I paid 18% GST on that entire premium paid to the insurance company because the risk is ongoing. Can I ask the insurance company to give back the GST to me and take it back from the government? And in my view, the answer clearly would be no. The guidance to this is given by Section 14, which deals with a situation of a change in the tax rate. And very simply put, there are various situations mentioned therein, but I always understand this provision with a simple criteria known as 2 by 3 criteria. Essentially, friends, what that section tries to look at is three trigger points of taxability. One is receipt of money from the customer. One is you raising as a supplier, raising an invoice to the customer. And third is completion of service, making of a supply. Now, if two of these three criteria happen in one regime, so when you have a change, you have an old regime and a new regime. So what you have to do is you have to check whether two of these three criteria fall in the old regime or fall in the new regime. If two fall in the old regime, the old rate will apply. If two fall in the new regime, new rate will apply. That is the broad sum and substance of Section 14. Now, continuing my neighbor's example, the premium receipt itself is a invoice, and that happened in July, which was in the old regime. The payment naturally was made by my neighbor to the insurance company in July. As far as the risk part, the insurance part is concerned, there can be an interpretation issue whether the entire supply is made on day one with only a consumption of the supply over the 12 months or whether the supply extends over 12 months. But because two out of the three criteria are already in the old regime, we don't even need to go into that academic debate of whether the risk is continuous or whether it is at the inception. So effectively, since two are in the old regime, the old tax rate will apply and you cannot claim any refund or you cannot expect the insurance company to give you back any money in these types of situation. So that is how one will look at the 2 out of 3 criteria. We also have interesting situations where, let us say, you have a maintenance contract and those or let's say a leasing contract, because maintenance there is no major change in the tax rate, but we are seeing a change in the tax rate of certain products. And we are aware that if a product is leased, the higher charges of that product bear the same tax rate as the underlying product. So, for example, if I am leasing medical equipments, and those medical equipments initially were liable for 12%. I am now leasing those equipments, and those rate on the product has been reduced from 12 to 5%. The question which comes is, for the month of September, you might be cumulating all the entire lease rent and charging it in the first week of October. Now, when you charge the lease rent for the equipment rented for the month of September on the 1st of October, the question comes is whether you will apply the 12% old rate or whether you will apply the 5% new rate. Again, we'll go by the 2 out of 3 criteria, and what we will is raised on the 1st of October. Supplies are partially initiated in the old regime, completing in the new regime for that specific month's lease rentals. But payment is also received in the new regime. So, 2 out of 3, invoicing and payment, both happen in the new regime. And if both happen in the new regime, clearly the new tax rate would be applicable in these types of situations. Irrespective of the fact that, yes, for 22 days, the leasing pertain to the old tax period, that does not matter because 2 out of the 3 criteria are in the new regime. That is as far as services is concerned. But when you look at the goods, we also need to bear in mind the provisions which require an invoice to be raised at the time or before the removal of the goods. We also need to bear in mind that there is an e-way bill requirement and because at the time of movement of goods, and that e-way bill is integrally connected with invoices in case of transactions which constitute supplies. And therefore, essentially, there is no major impact of transition except where let's say you are raising an invoice on 21st and shipping the goods on 21st, which will reach the customer on 23rd. Now, in these types of situations, clearly because your invoice is of 21st and your shipments begins on 21st, you will apply the old tax rate. And there is no need to change the tax rate or change or cancel the e-way bills for goods which are right at the movement stage at the time of the change in the tax rate. This has also been clarified by the frequently asked questions which have been issued by the government at this point of time. So I think that as far as goods is concerned, we don't see major challenges on this front. But challenge in goods comes in slightly different context, not at a transactional level, but at a business level. Because essentially the same goods manufactured by the manufacturer pass through an entire supply or a distribution chain. And therefore, there might be some goods which have been manufactured by the manufacturer in the old regime and they have not reached the final consumer. They are what the industry basically knows as secondary inventory lying in somewhere in the supply chain with a distributor or a dealer. And in these situations where there is a change in the tax rate, there can be certain issues which can come in. The first situation which we need to look at is a situation where a taxable product becomes exempted. Now, if a taxable product becomes exempted, there is a provision in the law which says that there will be a requirement of reversal of input credit claimed for the goods lying in stock. So, essentially, consider a situation like milk, which has moved from taxable to exempted, UHT milk, which has moved from taxable to exempted. Of course, it won't have a very widespread impact, but just to understand the concept and the thought process, the manufacturer of the milk would have charged GST because he would have cleared the goods before 22nd September. Those goods are lying with let's say, a dealer of that milk. He has paid the tax to the manufacturer and he would have claimed the credit before 22nd September. But because those goods have not been sold before 22nd September and lying on stock on that day, he will be required to reverse the credit which was already taken. And this is where we will see that the dealers or distributors will be hesitant in passing on, especially where the goods are moving from a taxable to an exempted regime, they will be hesitant to pass on the benefits to the extent of the inventories which are lying along with the dealer or the distributor. And we are aware that many products like FMCG products might have a long inventory life. They might, be there for 6 months or 8 months, and therefore the benefit of the tax rate change will need some time to percolate at the ground level, unless the manufacturer and the distributor decide to reject those goods and do a reverse logistics, which we will come to into a little bit more detail when we go to the challenge of the auto dealers, which is a larger challenge as compared to many other sectors. So one is that example where your product goes from, let's say, 5% to nil or 18% to nil. Other commonplace example is a product moving from 12 to 5 or 18 to 5 or 28 to 18. In these cases, this is merely a rate change, and therefore the circular also clearly explains that this will not have any impact. If a distributor has bought a product at 28% and he's selling the product at 18%, he can still continue to claim the credit of 28 and he will pay output of 18. Necessarily, what this will mean is that the dealer or distributor might have, for a particular product or a transaction, a little bit of an accumulation unless there's a margin. This accumulation can get adjusted against other products or other margins. So again, there might be a stamp depending on the inventory lying with the distributors in these types of situation. They can face a temporary cash flow issue, but it is not going to be a profit and loss impact or a major impact in terms of the profitability or the cost of the product. So a small impact, but not a major one. In some situations, especially some products like monitors, which high-end monitors today are 28%, they are reducing to 18%. And here, typically in these types of electronic products, the margins available with the distributors are very minimal. And anyways, those distributors are standing on a pile of input credit. And therefore, the question which comes is, in these types of situations, if I have no visibility of adjusting this extra 10%, because as a dealer, I paid 28% on purchase, but I will be paying only 10%, collecting only 18% on sale. So there is a 10% which gets accumulated or goes out of pocket, maybe as an asset, but it continues as an asset. So the question is whether I can, in these types of situations, invoke a refund mechanism of inverted duty structure. And the FAQ clearly says no, the product is the same. There is no change in the the input rate and the output rate, and therefore you cannot apply for a refund of inverted duty structure. The accumulation will continue till the time you are able to absorb that accumulated input credit against some other additional output tax, either on account of value addition or on any other account whatsoever. So that is the challenge which comes in, to some extent, limited challenge, but yes, that challenge very much exists. The challenge is compounded, and a lot of discussion has happened on the auto sector, because unlike just a rate change, in the auto sector there's also a merging of the basic tax of 28% and the cess. And so moving forward, we do not have a cess. And as we are aware, under the GST provisions, the credit of cess can be adjusted only against cess. So a dealer who gets, who has an accumulated input credit in terms of compensation cess for the purchase of the auto cars, maybe in the past, will have no mechanism to adjust or utilize this compensation cess. And how do we, does it that which ultimately some auditors will force you to write off in your books of accounts, or is there some mechanism by which you can encash it? I think there is, as of today, no clarity. There are varying thoughts, and I'm sure at some point of time the industry is aware of this issue and has represented already to the government. We'll have to wait and see how the government moves on this front and what type of a relief they try to bring in for this transition cess. First-hand reports suggest that there is around a blockage of 3,000 crores at an industry level because of this compensation cess accumulation. So naturally, the government will have to think through this entire process. And if it does not, maybe the industry will have to adapt itself and somewhere look at rejection of the inventory by the dealer, the manufacturer claiming a refund, because for a manufacturer, for a non-consummated sale, he can still go ahead and invoke what is known as Section 54 and apply for a refund for supplies which have not been concluded. So that is something which we will have to see somewhere closer to the 21st, unless a change in the transition provisions come in. Rejection might be a possibility to salvage this compensation cess. Otherwise, we are worried that there can be a difficulty on that front. That takes me to the next impact of the tax rate changes, especially where the tax rate is moving from some tax rate to nil, or a situation where it's moving to a slab which is 5% without input tax credit. A very common impact of this comes in the case of hotel sector, where we are aware that the current rate for hotel accommodation below 7,500 per night is 12% with input credit. Now we are transitioning that from 12% with input credit to 5% without input tax credit. And when you have a situation of a condition of non-claim of input tax credit, it is treated is equivalent to exempted supply. You cannot claim corresponding ITC. And you also have an impact of Rule 42. We are aware about Rule 42, which says that if an entity is dealing in both taxable as well as exempted activities, then you have to reverse proportionately the credit attributable to exempted supplies. Now, because your exempted supply value will increase, the provisional reversal from the month of September onwards will keep on increasing. Please bear in mind that at the end of each year, you have to do a final reversal by the month of March. So for the current financial year, you will do a final reversal in March 26. And when you do that final reversal, the ratio for of exempted supply to total supply would have changed because of the change in the tax rate. And therefore, to some extent, it will have a retroactive impact on the common credits claimed from April to August. Because of the ratio, some portion of the credit which has already been consummated will also be required to be finally reversed in the month of March. Materiality may not be big depending on the situation, but that is a trigger point which we need to bear in mind. That takes me to the other substantive changes, and I think two important changes. I think the first change is a widespread application, which is the deletion of Section 13(8)(b), dealing with intermediary services. We are all aware that the law has been interpreted by the officers right from 2004-5, when service tax was finding its teeth in a slightly myopic manner. And this basically covers situations where a person sitting in India helps a foreigner provide a service in India or sell goods in India. The end consumption of the product or the service by a foreigner to an Indian importer is happening in India. But that transaction is facilitated by somebody sitting in India, a representative, sometimes known as an indenting agent, sometimes known as a commission agent, or sometimes known as a representative, different names used for them. And somewhere the bureaucrats have always been slightly myopic to look at the end result and say that, look, I am seeing a final product in India. And if the final product is coming in India, just because you are dealing with a foreigner, I cannot give you an export benefit. And we had a classic case of Vodafone, which went in two lines of circles, and recently the Supreme Court had to finally settle this issue. And the objective and the key observation of the Supreme Court, and which is the correct way of looking at it, is to say that GST being a transactional law, you have to look at the transaction and not the last leg of the transaction. So in this example, and Vodafone was a very classic case wherein Vodafone India was providing interconnection services to customers of Vodafone UK. And for the said purpose, for the roaming, it was collecting charges from Vodafone UK, not from the end subscriber. Vodafone UK would then collect it in its billing from the end subscriber. So in this situation, the department was saying the call is landing in India when the citizen, the person, the subscriber is in India, and therefore please pay me the GST. And Vodafone used to say that I am providing a service to UK, and it is then UK who is providing a service to the end subscriber. So I am not concerned with that transaction. And this is essentially what the Supreme Court also held. It said that you have to look at your customer, not the customer's customer. That is the end use, but the immediate use is by way of providing a support service to Vodafone UK. And therefore that judgment was there. But at the same time, the GST law in the meantime had brought service tax law, and then GST law had brought in a provision called intermediary service to cover all these commission agents. Again, a lot of debate happening on that front, and somewhere better sense prevailed, and now we are dropping that provision of intermediary. And therefore, if you are dealing with a foreign customer, you would be eligible to claim the benefit of exports, and this condition of intermediary will no longer apply. It helps two sectors. One is those commission agents, indenting agents, etc. What was also happening was at a ground level, many officers ended up stretching the interpretation of intermediary to say any case where there are three persons involved, even if the person is not acting as an intermediary or acting as a covered there. So, for example, if there's an IT outsourcing unit and it just undertakes calls and solves client complaints of foreign customers, the department used to say what you are doing is also intermediary, and there were disputes. And of course, the department, CBC, then came up with a detailed circular in this regard. Despite the circular, there were disputes and rejections of refunds and disallowance of export benefits. Now, with the amendment in the law, I think even that sector will not face those types of controversies. We had a major challenge in the freight sector, wherein people who are trading in freight were called intermediaries, and they were said that okay, we will not give you these benefits and we'll expect the tax payment. So I think all of those controversies will be settled and will have a little bit of a better footing in the future. Please note in mind, this amendment is a substantive amendment, will require an amendment in the law, and therefore it is not immediately effective. It will be effective future date and will apply for future transactions. If you have some litigation in the inventory or in the pipeline, that litigation will have to be contested on the basis of the old law, and it will have to reach its logical outcome at some forum on this front. So, but yes, moving forward, at least we are reducing the fresh pileup of litigation on this front. Similar is the issue for discounts. As we are aware today, as a supplier, you are allowed to reduce a discount from the value and give a GST credit note only if it constitutes what is known as a pre-supply discount. And a pre-supply discount is defined to be either a discount which is mentioned in the invoice or which was agreed upon at the time of supply. Basically, meaning that it was emanating out of a pre-agreed contract prior to the supply of the goods. Now, this led to lots of interpretation issues of whether the discount claimed by the manufacturer is a pre-supply discount or a post-supply discount. And therefore, what we are proposing is Section 15 will be amended to not only permit a pre-supply but also a post-supply discount. The press release also says that the credit notes need not be linked with the invoices in the future. According to me, this amendment was already carried out in the past, but maybe somewhere we are also bringing it once again. No harm in trying to say it twice. So that's fine. We are now told that the credit notes will not be linked with the need not be linked with the invoices also. Last year there was a circular mandating a requirement of a CA certificate or a self certificate to demonstrate that the recipient has reversed his ITC. And this logic is very clear. The supplier can reduce his input credit, reduce his output tax only if the recipient has reversed his ITC. It cannot happen that the supplier repays reduced tax by claiming a deduction of discount, but the recipient does not reverse his ITC. In that case, government goes out of pocket, and naturally, that is not the thought process, and that cannot be expected also. So, but how do we ensure that the recipient has reduced his ITC? So, there was a circular issued by CBC saying that you please provide a certificate, and this had actually created a lot of difficulty and a procedural pain at a ground level. After that circular was issued, the government also implemented a scheme known as invoice management system. It is a system on the portal. As of today, it's optional, but as far as credit note is concerned, the implementation is mandatory in terms of deemed acceptance or rejection. You cannot keep the transaction pending. And because that IMS system is now tracking this entire reversal or mandating this reversal, we are told that we will withdraw this circular, and moving forward, this certificate will no longer be required. There's also a discussion on a clarification to be given regarding a financial credit note. We are aware that GST credit notes is subjective. It can be given only in case of pre-supply discounts, and it results in a reduction of the GST of the manufacturer. But in certain cases, the manufacturer is not interested in going into all this zone, and he says that I don't want the GST benefit. I will not issue a GST credit note. I will issue a credit note. I will give you a discount or a reduction in the price, but I will not pass on the GST burden to you. In that case, the market and the industry uses the word financial credit note. And these financial credit notes, there was a debate at the recipient end whether he is required to reverse input credit for these financial credit notes as well. So while it was originally also clarified, the CBC says that we will once again clarify that a financial credit note will not create an obligation for reversal of input credit at the recipient's end. We are also expecting two further clarifications on treatment of post-sale discount, which is in the nature of additional consideration paid by a manufacturer for a third-party transaction between a dealer and an end consumer, typically known as price protection discount or some cashbacks or something which has been given as a special scheme. Those we'll have to wait for the circular and see what are they trying to say, because initially there was a draft circular on this front, created a lot of difficulty, and therefore the draft circular was withdrawn. Well, let's see what is the thought process. It's still not out, but yes, we are told that there will be something on this front. Similarly, there will be a circular on a situation where the dealer or the distributor is undertaking certain promotional activities like sponsorships or road shows or something like that, and recovering those amounts from the manufacturer or getting a reimbursement from the manufacturer in this regard. So I think those are the substantive changes which we are talking about. We now go to a small procedural changes, and again, while we always try to achieve an ease of doing business, we find that somewhere as an employer, the CBC needs to keep on reiterating things which are already said, so that the intentions of the CBC and the finance ministry to really bring in an ease of doing business happens. But unluckily, we are seeing that all of that is just a paper. And when it comes to ground level implementation, with due respect, we find there are lots of challenges. And that's the reason why 8 years down the line, when we brought in GST, it was easy to get a registration. We used to get a registration in 1 day or 2 days. And after 8 years, in between, of course, there was various course corrections. We made the registration process more and more complicated. And after 8 years, we are now announcing simplified registration scheme for small businesses who are primarily dealing with end consumers or having small element of B2B supplies. I will have to actually look out for the real benefit to come out from this front. We are also told that for refund applications, exporters, suppliers to SEZ units, inverted duty structure refunds, a provisional refund of 90% will be given immediately, which also has been there on the statute for quite some time. To some extent implemented, but to a large extent, again, seeing a lot of aberrations. So I think these are small benefits which are being talked about. But having said that, what ultimately will matter on this front is the actual ground level implementation. And that's where I think the last major amendment before we circle back into our sectoral discussions and the tax rate changes is the fact that end of the day we are now seeing some visibility on the setting up of the GST appellate tribunal. A robust litigation dispute resolution mechanism is a must for a stable implementation of any law. And we have seen the effect that because we do not have a robust implementation mechanism, we find that the field formations at times are in a position to have a large handle and a free run at times because there is really no effective dispute resolution mechanism. The GST appellate tribunal has been set up, but it is still not functional. So we are now told that yes, the systems will be ready and we will start accepting appeals by end of September, and all the pipeline appeals for the last 8 9 years will set up a last due date of 30th June for all the pendency of appeals to be filed. And thereafter, the hearings, of course, will also happen simultaneously. And because of this reason, many organizations might have had adverse appellate orders, and they will have to really take a stock of all the pending litigation matters And wherever the appeal has been deferred because the GST appellate tribunal was not set up, they should now go ahead with the identification of the issues and the reconciliations wherever required and start preparations towards the appeals so as to enable that all the appeals get filed by the 30th of June 2026. With that, we quickly move into the sectoral rate changes, and I think the biggest couple of sectors which we are going to talk about, one of them is the auto sector. We are aware of the major relief which has been sought to be given. As we are aware today, all cars are in the 28% bracket except a few exceptions like EVs, etc. We are now told that the 28 bracket to a large extent will go to 18, and that basically covers small cars, motorcycles, buses, trucks, ambulances, three wheelers. All those products will now be into the 18% tax rate. Some luxury cars, where basically vehicles exceeding 1500 cc or utility vehicles, will fall into the 40% bracket. Again, please don't understand that this is an increase in the tax rate, because 28% also had a cess. With this 40%, the cess is not there. So effectively, the tax rate is either similar or slightly lower. Same 40% demerit rate will apply for personal use aircraft and yachts. The compensation cess issue, which we discussed earlier, is a transition issue and it's very much a live issue. But subject to that issue, I think overall this sector ends up benefiting because of a substantial reduction in the tax rate. In fact, some of the car dealers, car manufacturers have also announced benefit of this GST being passed on, and the revised pricing also have been announced for various of the models of the cars. The auto sector had a major litigation not only on the output side, but various auto parts. The manufacturers of auto parts were facing challenges because of a conflict of certain chapter notes, and whether an auto part, something like a nozzle, should it be covered under the iron and steel products, or should it be covered under an auto part and therefore be liable for the tax rate of auto part, was a debate, and lots of interpretation and litigation was going around. There were conflicting Supreme Court decisions on this. With one important change, we are bringing all those controversies to a knot in the future. We are told that in future, all auto parts, irrespective of their HSN code, irrespective of the chapter heading and classification, will bounce back to 18%, and therefore that entire controversy of whether we will tag it to 18 or 40 will no longer be relevant. FMCG sector and the common man, this is where the finance minister in her press release talked a lot about. And here there's actually a lot to cheer about. A few of the FMCG products which were treated as luxury, charged at 28, are moving to 18. You have air conditioners, dishwashers. Some TVs were already 18, but larger TVs, smart TVs, and larger monitor sizes were all in 28. All of them are now consolidated back to 18. And a wide range of daily use products are moving from 1218 to 5, right? From hair oil, toilet soaps, footwear, talcum powder, diapers, you have paintings, you have utensils, a long laundry list of products going from 12 or 18 to 5%. And I'm sure the person who are manufacturing these products would have definitely examined the HSN classification and looked at those tax rates. Interestingly, for services, the beauty treatment and the beauty parlor services, the health clubs, salons, barbers, fitness centers are moving from 18 to 5% without ITC. Please note, in this sector, input credit is being denied. It moves from 18 to 5 without ITC. That takes me to the infrastructure sector, and I think a major change there is a reduction in the rate of cement from 28 to 18, and various types of flooring materials from 12 to 5, like marble or lime bricks, etc. They are moving down from 12 to 5. So in that sense, real estate sector definitely will get benefited, because while these are inputs for them, most of the real estate entities do not get input credit, and therefore they would see a little bit of a benefit of this nature. But as far as many other people are concerned, essentially this may not result in a benefit, because 28 was also creditable, 18 also continues to be creditable to them, especially if you are into businesses. End consumer, naturally, they will benefit because of this rate change. Another major rate change is in this sector relating to the oil and gas sector, where as of today, for certain oil and gas exploration and production services, especially if you are dealing with ONGC or Reliance or HPCL, you might be entitled today for a concessional tax rate of 12%. Now, as we said earlier, there is no 12% moving forward, and therefore this 12% bounces back to 18%. And naturally, you might need to request ONGC or someone, whoever is your client, for the additional 6% moving forward. Similarly, earthwork related contracts and their subcontractors, all of them move from 12 to 18. That takes me to the hospitality sector. One is, of course, a small clarification. We believe that this was the original interpretation that a standalone restaurant cannot opt for 18% with ITC. They have to discharge GST at 5 without ITC. This was a stated law ever since 2018. And I don't think, but there were certain conflicting views which were floating around on this front. So the CBC is now saying that we don't want to unnecessarily create controversies. Let us be very clear saying that you cannot go for 18, you have to go for 5% without ITC. But a major change is coming for hotels, and I discussed that a few minutes back. That if hotels are having an actual room rate of less than or equal to 7,500 per day, the rate is reducing from 12% with ITC to 5% without ITC. So those are the two major changes as far as the hospitality is concerned. Moving to the food product sector, where if you are selling the products, food products as a sale across the counter, there we see a lot of consolidation, and we see that two, three things happening. Some priority products, all types of Indian breads like parathas, rotis, etc., moving from 5 or 18 to nil, UST milk moving to nil, and paneer moving to nil. And over and above that, most of the other products, processed foods, are moving from 12 or 18 to 5. And therefore, you see things like namkeens, bhujiyas, sauces, coffee, chocolates, ice creams, dried fruits, biscuits, cakes, all of them moving from 12 or 18 to 5%. To some extent, this is also a realization of the fact that these are sectors which are slightly unorganized, to a large extent consumer facing sectors, and therefore the risk of non-compliance is much higher if the tax rate is high. As an end consumer, if you are going to buy a cake and you're told that if you take a bill you will be paying 100 plus 18, you will have a little bit of an hesitation to say that okay, I don't want a bill, please give me to me at 100. And then naturally the supplier also has a little bit of an inclination to evade these types of tax. But not that it is a correct way to do it, but that inclination is very much there, and because of the unorganized sector it is always difficult for the government to catch hold of these people. I think that realization results in this reduction or rationalization of the tax rate. And if the tax rate is lower, the inclination to really do a shortcut reduces both at the consumer level as well as a supplier level. Having said that, certain types of aerated beverages like soft drinks and caffeinated beverages, we are moving from 18 or 28 to 40%. So that is a small change which comes in at that regard. Another major change which has been talked about a lot is individual life insurance and medical insurance, given an exemption, including reinsurance, therefore. But yes, as far as the insurance company is concerned, there will be a small impact of ITC reversal because of this exemption. But yeah, more or less, this results in a substantial benefit. It actually takes the government objective of ensuring better insurance and health cover for the general citizenship. I think this is a good move. Only a small challenge which we see here is that many companies provide group mediclaim policies to their employees. The exemption is only for individual life and individual health insurance policies and not for group policies. And therefore, there is going to be a challenge at that front. The company would still end up paying a GST for mediclaim insurance taken by employees. It would not even be eligible for input tax credit. So we are aware of group mediclaim being a part of the block credit list. So that's a challenge which they will keep on facing. On the product side, many of the products are moving from 12, 18% to 5%. All drugs and medicines, various medical apparatus and equipments are moving from 12 or 18 to 5. Some life-saving drugs are moving from 5 or 12 to nil, especially if they are used for cancer and rare diseases and other chronic diseases. There is a movement from 12 or 5 to nil rate. So that is, I think, an important move again to make healthcare more affordable to the end consumers. As far as transportation and logistics is concerned, they had a couple of entries at 12%. Those entries are moving to either 18 with ITC or 5 without ITC. It's something like a GTA forward charge. You had rail multimodal transportation, which was at 12, or you had renting of vehicles at 12, which moves to either a choice of 5 without ITC or 18 with ITC. That's, as I said, a consequential change. But I think the freight forwarding sector will be largely benefited because of the deletion of the intermediary service. And because of that deletion, the controversies surrounding the denial of export benefits will be no longer applicable. Just a last slide to look at some of the major changes in other sectors. Certain agricultural machineries, the tax rates are being reduced to 5%. Again, fertilizers, which are inputs for agricultural and an end farmer, reduced from 12 or 18 to 5%. Cess coal is being increased from 5 to 18, but because there was a cess, it results in a consolidation, and end of the day, it does not impact the cost drastically. Renewable energy devices like solar plants, biogas plants, etc., reducing from 12 to 5, again a welcome sector. Most products in the textile sector reducing from 12 to 5, except large value ready-made articles like about 2,500 per piece, which moves from 12 to 18. Otherwise, most of them move from 12 to 5. Job work, certain job work were as a 12% bracket, all of them are moving to 5. And finally, gaming lotteries, which was from 28, moves to 40. Again, no cess on this also. So that's again one more area which one needs to bear in mind. So I think that's if you look at the overall changes, you'll find that there are lots of changes in terms of reduction and consolidation of tax rates. And that's where in the press conference, one question which was repeatedly asked was the revenue impact. And the revenue secretary was slightly guarded, and he did highlight at some point of time that there can be a calculation of 48,000 crores of a revenue impact, but that we are confident that there are, we gave three or four parameters and said that we are confident that we are not required to have a fiscal impact of this, because perhaps there will be a buoyancy, perhaps there will be better compliance, and because of those better compliances and buoyancy, we might end up with a same revenue target at the end of the year. Now that takes me to the real ground level reality. And the ground level reality is that yes, we make a announcement of a relief of 48,000, apparent relief of 48,000 crores. But a revenue officer needs to just issue one SOCOS notice to Infosys of 32,000 crores on an interpretation of an issue which is starkly contrary to the legal provisions, as well as contrary to their own internal guidelines, including the CBC circular. Now, if this is happening, naturally we will continue to see increases in GST despite there being a reduction in tax rate. And that's where maybe the end consumer might be expecting a reduction in tax rate. But if you are looking at businesses, businesses are least concerned with the tax rate. Yes, it is important, but what is also equally or more important is the facet of ease of doing businesses. If obtaining registrations, people need to knock the high court. If for any small matter like this, there are huge demands which are created, and when one goes to the regulatory filings at the BSE or the NSE, you will find that every second or third day there is somebody saying that I received a 5,000 crore notice, I received a 1,000 crore notice. Something is amiss, and I think this is something which will need to be taken care of. And I would believe that we can really name this as GST 2.0 only when there is this ease of doing business. Till that time, yes, a good step, a major step forward, but I would still believe it can be at the most GST 1.5. It cannot be termed as GST 2.0. With that, I conclude my talks, and I'll hand it over to Sharai. Depending on the time, we can take one or two questions.
Yes, thank you so much, Sunil ji. We are now open to questions, but considering the time constraint, we won't be able to take many questions. So please do send in your questions and we'll try to take it from there. Yeah. I can see there are already a few questions. So one of the questions is from someone called KK. Can you listen me, Sunil?
Yes, yes, yes.
Yeah. So he has mentioned that most of our products are likely that fall under 5% GST rate category. And we seek your clarification on the treatment of GST input available on purchases made prior to 22nd September. So their question is whether the company can continue to claim such input and utilize it against the 18% output supplies. This is the first
The
one.
answer, what I'll do is each question I'll answer individually, so it helps. So to pause here to answer this first question, yes, you can continue to claim the credit, and you can utilize it against any other output. Let it be a service income also, it does not matter. This has been clarified by the FAQs issued by the government itself. So I do not see any concern in utilizing the claiming the credit or utilizing it against the other output.
There's also a second part to that question. So, whether it is advisable to temporarily stop purchases of such products due to upcoming GST rate change, considering some items are being procured at 12%.
So if you have a visibility of adjustment, I don't think you need to do that, no, because as I answered your first question, you are anyways going to adjust it. So if there is a possibility of adjusting against some other service income, why do you want to disrupt your businesses unnecessarily?
There's another one from Gerald Martin. He's asking for credit notes. Is it applicable for earlier years or only raising after 22nd September 2025?
So the detailed circular is still to be out. I would believe that because of the implementation of IMS, they might put a cutoff to say that this will apply only for credit notes post that period. But we don't know. We will have to wait for the circular to be out to be clear whether it will apply for the old credit notes or only for the credit notes after this period.
Okay. We have next question by Vijay Kumar. We have service business wherein we are getting service charges from overseas parties, wherein we are paying GST since it is coming under intermediary. Now this intermediary is eliminated, so no GST liability will come. Please confirm my understanding.
Yes, that is correct. But as I said in my presentation, the effective date is still not out. So please wait for the amendment in the law and the notification. It definitely won't be 22nd September. It will be beyond that. Please wait and track the changes in this regard, and only thereafter discontinue the GST.
Okay, next question is by Prakash. What is the new GST rate for prickly heat powder? Will this fall under talcum powder?
I would believe so, but again, I think this is very specific product specific interpretation, and you might need to look at the correct HSN classification and advanced rulings or controversies in this regard before one can really close this discussion.
We have next one by Jitendra. Export services of commission, how will that be impacted?
So as I explained to Vijay Kumar also, this would be exempted. As of today, people are paying GST on this. This will get exempted. There will be no GST because it will be treated as an export. And the date of implementation is still to be announced.
Okay, next is by Nilesh. Can companies continue using financial credit notes instead of GST credit notes for post-sale discounts? Because we do not want headache of IMS for deemed credit notes acceptance.
Yes, that choice is always available.
Okay. Next is by Bhavin. Um, Grammage increase for hair care products will constitute as passing on benefit to customers and not reduction in MRP due to GST from 12% to 5%.
I think that should be perfectly fine. If you increase the content instead of reducing the price, that should be perfectly fine.
Okay. We're closing the questions, guys. So just last two questions. Next one is by Deepak. Whether GST will be chargeable under RCM on commission of export sales.
Yes, if you are an exporter and you are paying commission to a foreign agent, Till now, you are not paying GST under RCM, treating the intermediary condition. Now you will have to pay the tax under RCM and thereafter claim input credit. And because this will result in accumulation, you will add it into your refund claims.
We have next question by Manish. We received incentives on sale from the brand. Is it liable for output GST or we need to reversal it for ITC?
Manish, as I was highlighting when we discussed the discounts part, that the department is going to come out with a couple of circulars interpreting what should be treated as a independent service as an or an additional consideration and what should be treated as a discount. So I do not want to go into a premature discussion of it. Please let us wait for the circular and basis that circular, let us then interpret this to our facts of the case.
So this is the last question by Jitendra. Local freight included in goods invoice. What will be the GST rate applicable? Can ITC be availed on this?
The local freight which is recovered in your invoice itself is a part of the product value, and whatever be the product rate will be the applicable GST rate on that entire product.
Okay, I guess we'll just conclude over here. We have many questions coming in, but I'm also looking at the time. So can we take one last question, Sunilji?
Sure. I think Vishal's question is already answered. I think that's why the
Okay, yeah,
same
that
question
was the
was
one I'm
asked by
talking about. So yeah, it's answered. Yes, okay. Thank you. Thank you so much for joining us today, everybody. And thank you so much, Sunil ji, for conducting it. It was a pleasure hosting you. And we have done so many webinars in the past, and we look forward to hosting you again. Thank you,
It's a pleasure.
everyone. And we'll be sending a follow-up email that will have Sunil ji's recording. So you can, go through it and share it with your peers. And I've also attached a link which will help you join our Elevate community where we'll share updates about our webinar and all the things related to GST compliance. So yes, thank you so much, everyone. Thank you so much, Sunil ji. Look forward to
Pleasure.
hosting you again.
Thank you.